So the background probably looks different to you. I am in Seattle. We left the valley, Silicon Valley, after 19 years and moved up to be with family. And it just feels so good. In one direction of where we moved, we're in temporary housing. My parents are about 20 minutes away. And then in the other direction, my sister and brother-in-law are in the other direction. And man, it just feels so good to have family support. And I haven't had it for so long because, well, no one lived in the Bay Area, no one lived in Silicon Valley because it's so darn expensive. So Burgess and I finally made the call to say, you know what, let's get out of here. Let's move to a place where we have support. And just to be quite honest with you, the uptightness and just the tightness of living in Silicon Valley has been getting more and more and been grating on me. And I finally said, you know what? I don't want to be here. So it's good to be with you guys. And I want to share something with you. Most of you know because I've shared it that I have dyslexia. And I remember this time in college where I could not figure out how to spell the word due diligence. And it literally took me about a week to figure it out because I was spelling it so badly. And this was before spell check, where you could just type in a word. Well, not before spell check, but to type in a word and you'd get the right suggestion. But I was typing the word in or looking for the word in the dictionary, and my predictive skills of how due diligence was supposed to be written. First of all, I didn't know it was two separate words. It took me days and days and days to finally figure out how to spell due diligence. And I remember even going to a counselor and saying, how do you spell due diligence? And I don't know if she didn't know how to spell it herself or she wanted to make sure that I went through the process of learning. But either way, I remember going through that process and thinking like, wow, I should have stopped predicting and kind of been more diagnostic and really thought about how to get the actual spelling. And the theme of this weekend's thought is really about, am I diagnosing something or am I predicting something? Are people diagnosing the market or are they predicting the market? And so what I want to do is jump behind the camera and I want to show you how painful it can be if you are predicting. And I can also show you how much more stability one would have, you will have, people have, when they start diagnosing the market and not predicting it. So give me a second and let me get behind the screen. Since we've been little kids, we've wanted to know exactly what the rules are. And the reason we want to know what the rules are because we want to have this certainty to our future. And one of the reasons why a lot of people don't like the stock market is because the price changes every second, right? What you own that is traded on the stock market changes every second. And so that change in price feels very unstable. Even so much that if the price keeps going higher, there's a point where you start feeling like it's unstable. And so I had this idea, and I've used it before, but there's this idea of this financial vertigo, right? So the definition of vertigo is a sensation of whirling or a loss of balance associated particularly with looking down from great heights. And I get the experience that when you have price going higher, people start getting financial vertigo more and more, right? And it's because it feels more and more uncertain to them. And what they want is certainty. But what's crazy about the human brain is when it gets certainty, it's not satisfied with certainty because it assumes there's always going to be something after it. So I know this sounds really crazy. So it creates uncertainty so it can then get back certainty. I hope you followed that. But that's exactly what I've been seeing in 2 decades of looking at people's accounts and approaches, that they want something and yet when they get it, then there's a part of them that doesn't want it. So I saw this picture of vertigo. I thought this is what I think a lot of people are having right now. So I don't predict. I don't know where the market is going. I didn't know what was going to happen in 2008 when I sent an alert out in January. I think it was January 15th of 2008 to say get out of the market. I didn't know what was coming. I just knew from a diagnostic point of view that something had changed, right? So I wasn't predicting anything. I was just diagnosing what was happening. And so I want to diagnose with you 4 charts. And the first chart is just looking at Europe. Now, I'm only looking at, say, a year and a half of data, but still, if I were to diagnose Europe through this price chart, what I see is, from a diagnosis point of view, it looks pretty good. It's going from lower left to upper right. All things being equal, when a price is hitting new highs, new 52-week highs, new 104-week highs, there's no such thing as that, new lifetime highs, that is a sign of stability, right? And then you look at the US during the exact same time period, the last 18 months, and the US is doing something very similar. It's going from lower left to upper right. That's a sign of stability. New lifetime highs is a sign of stability, not instability. And then you look at the total international market. Now, I first showed you Europe, so that was just Europe. That was an ETF, FEZ, that just showed Europe. Then I showed you the S&P 500, call that the US. This price chart is showing you the international stock market. So this is all developed markets in the world except the US. And when you look at this and you go from a diagnostic point of view, you say, well, this looks like stability, because it is stability, because it's going from lower left to upper right. So again, when you diagnose it and not predict, now I don't know where it's going, but I do know Newton's second law of motion: something in motion will stay in motion till something of equal and opposite force pushes back against it. So things stay in motion much longer than we can ever imagine, and that's both on a trending higher and on a trending lower point of view. Things on this planet want to trend. Things going sideways, that is not nature. Nature moves in a direction, and nature is never wrong. And then the last market, let's call this emerging market. Emerging market. So look at this. This has stability too, right? It's going from lower left to upper right. So what do we have here? We have 4 markets on the planet, the only 4 markets on the planet from a location-based point of view. You have the US, stable. You have Europe, stable. You have international, developed, stable. And you have, really, this is international, emerging. And that is stable. So you have the 4 locations on the planet that are stable. And so I think a lot of what people are experiencing is what I would call financial vertigo. And it's usually because they've been caught up in the pick of the month newsletter world, where they've been getting scared the heck out of their positions, and they've become too conservative because they're not actually diagnosing it. They're more preparing for something that really hasn't happened for 8 or 9 years. Now, if we roll back the clock to the end of the 1990s, there was a 25% correction in the US stock market. This is when long-term capital management went out of business and the New York Fed bailed them out. By the way, that was a precursor to the Fed itself bailing out all of the banks in the US and outside the US. We bailed out a lot of banks. But after that correction, the market went up for another very strong 18 months. Now, I didn't put 18 months on these price charts to say that we're done. The point is that we could get a correction. We could not get a correction. That is predicting. What I'm telling you is do more diagnosing, do more diagnostics, and less predicting, and what you'll find is more stability in your life. Now, if you're thinking, well, our emerging market and international and Europe and the US always go up together because they're all kind of, doing the same thing, I just want to share this price chart with you here, which goes from the end of 2013 to the mid part of 2015. Right? So this is about 19 months. And the red line on this chart is the US stock market. And then Europe, emerging markets, and international developed are the 3 lines below that. So no, the markets do not always move in the same direction. And you know that by listening to my weekend thoughts. And the only point I want to make with this price chart is when all 3 locations on the planet are moving in the same direction, that's a sign of stability. I'm not predicting, I'm simply diagnosing and saying that is a stable market. Could we get a 10% correction? Of course we could. And we will eventually. But what you have to go with is what now, not what if. And you have to be prepared for what if, right? But ultimately you have to live in what now. Okay, the market's been up 8 years. All right, So what now? And the what now moves you back to the moves you away from the predictive and moves you into the diagnostic. Okay, so what is the takeaway first? Price direction determines, right? I'm talking about the price, and it's so obvious. This is so obvious, guys, that is very hard to see, right? Stability is a sign of stability. Price is moving from lower left to upper right is a sign of stability. It's so obvious when you hear it. And I wish someone would have beaten this into my brain before it probably took me 3 or 4 years in my 20s to figure this out. But guys, price determines stability. Price determines the profits you're going to have, right? And price determines the losses. And when I say price, I mean price direction. The price direction tells you where the stability is, where the instability is, where the profits are, and where the losses are. And the more you can diagnose the market and the less you can predict the market, the more stability you're going to have in your life. And that is exactly why you can be on the side of stability, how you can align your money to the market, and really start looking at it from a different point of view, a view that's not the long only big box advisor point of view, and a view that's not the pick of the month, let's really complicate things for you point of view, but from a point of view of clarity and stability and an elimination of the noise and the BS and the hype. And this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck.